What's up, everybody? Clint Powell here once again with Eric Buchanan and Associates. You can find out more about what he does and all of these conversations at buchanandisability.com. My name's Clint Powell, but let's just get right to it. It's where I get to ask Eric a question. And the reason I love these videos and these podcasts is because it's just that. He's come up with a really cool way of taking podcasts, the entertainment world, and putting it out there for you with a ton of information. And I've used Eric in the past and his team, and it worked out well for me. Let's just bring him up. Eric can tell us what he does, and then we'll jump straight into today's topic. Eric Buchanan in 3, 2, 1. What's up, buddy?
Hey, Clint, how are you? Good to see you.
I'm good. Good seeing you, man. Thank you for letting me do this on a consistent basis. And I hate to say this, I've done over the last 30 years, I've hosted a lot of things. I've been a facilitator for a lot of things, and I love doing it. Rarely do you get to do something that has a business purpose, but it's fun and entertaining to do. So kudos to you for doing that, sir.
Yeah, this is fun having these
Yeah.
conversations. I hope people learn a lot.
Yeah.
I hope a lot of people listen in. But we're
Yeah.
putting it out there for maybe just for that one smart person who wants to do a deep dive and learn a lot more. They can check out these videos. Maybe it's
Well,
more than one person.
maybe there's two. We'll double it next week and maybe get four. Do me
Yeah.
a favor though. Tell everybody, what you do at your firm, and then I'll ask the question to kind of get us started.
Yep. Hey, everybody. I'm Eric Buchanan. I'm a disability insurance attorney. Our office is located in Chattanooga, Tennessee, but we handle cases all over the United States. If you check out our website, buchanandisability.com, you will see the pictures of the other 5 attorneys that work here. We have a great team. We also have some great paralegals. We have a staff total of 15. We handle disability insurance, ERISA disability, long term disability, ERISA life insurance, private life insurance, some health insurance claims, and we do those claims all over the United States. We work with local attorneys in other places when we need to. We have attorneys licensed in different states that we can handle directly. There's some courts we regularly appear in that you're allowed to appear without a local attorney, but we work with local attorneys where we need to. We've got a lot of cases going on, for example, right now in New York and Pennsylvania. We've handled cases in Alaska and California. We handle cases all over the United States. And a big part of what we do, the way we're able to do that all the United States is, well, this is a little niche. Helping people with disability insurance is something not many attorneys do. It's also something, we'll get into this, that's the whole point of talking about today, where there is a real need for the right kind of help because the insurance companies are taking advantage of people, taking advantage of the system and deny claims that shouldn't be denied and leaving people in the lurch. And if they don't find the right attorney, a law firm like ours to help them, then they can lose a lot of their benefits, a lot of their rights, and maybe get nothing at all when they are most needing the help at this important point in their lives.
Well, it's also a system that, if you go back and listen to one of our earlier podcasts, it's also a system that the insurance companies were very involved in establishing. And so, it's one of those, hey, we put the system together and it's for you. And it's also for us. And here's how. And we're going to talk about today. It's the big numbers game. It's, in other words, let me start off asking the basic question. First of all, why are so many insurance claims denied? And is there a specific number? Does that fluctuate so much? It's like a running tally, like at a a marathon, a dial-a-thon or something.
Yeah, it's the answer to your question, how many claims are denied, is a very interesting one. And it's hard to get the statistics on that because the way the insurance companies will play the game is they'll say, hey, we pay 98% of our claims. But the 2% they don't pay are the 2% where somebody actually has a claim that's real money, that is the claim that lasts for a long time. So, if, for example, an insurance company is supposed to pay long term disability benefits, and anybody who's out for 3 to 6 months over after their elimination period, so they're off work for less than a year, yeah, the insurance company is probably going to pay that claim. Out for 2 years, yeah, maybe the insurance company is going to pay that claim. Somebody who's disabled for life, now it falls in that little category where they're going to look at it awfully hard and maybe probably not pay that claim. But that's not the majority of claims. It is the majority of the cases of people who need help. It is the majority of the cases that really matter, where people have become so injured or so sick that it's going to be a long time before they go back to work. Those are the cases the insurance company is going to look at awfully hard. But they can tell the whole world, hey, we pay 98% of our claims. We just don't pay any of the expensive ones,
Well,
or many of them.
I'll let you dive into this more, but, it's this I know we're gonna talk for a while, but this seems to a simple brain like me kinda easy to figure out. Here's why. It's all about numbers, is it not? I mean, it and I'll let you kinda take the conversation the way you wanna go, but if I got 100 claims, I'm Clint Powell, got 100 people. And over time, if I just send out a bunch of denial letters, some people are going to quit. Some people will miss the deadlines. Some people will lose. And of that 100, I may end up having to pay, four or five, maybe 10 of them at the max. But I'm going to make money that people paid monthly to me as an insurance company, and I'll never have to pay a dime.
Yeah, you're hitting the nail on the head. That the insurance companies are playing the game of numbers by denying a lot of claims and hoping people don't appeal. And let's put a pin in that for just a minute,
Yeah, yeah,
and
absolutely.
and back up one step and just help anybody listening to this podcast, this video. Let's talk about the basics. How does an insurance company make money, and how are they supposed to make money? So let's kind
Wait
of
a minute, hold on a
start.
second. Are you saying they're two different things? How do they make money? No, go ahead. I'm
Yeah,
sorry.
yeah. So
Yeah,
what? So if you look at uh, when an insurance company sells a policy, one big difference between what an insurance company does and most other businesses that we deal with, if you or I were to go down to Walmart and decide we want to buy a new computer screen or a new TV or a new microwave or whatever, what happens? We walk out of Walmart with the microwave, or we go to
right.
the camping department and buy a cooler. We walk out with that cooler. What happens when you go to an insurance company and you buy a policy? What do you walk out the door with?
Paper, a piece of paper.
Yeah. And what's in that piece of paper? It's a promise. It's a promise that someday they will provide you what you're paying for only if certain conditions are met. Other than that, they just take your money. So what's really going on in an insurance company is they have hundreds and thousands and tens of thousands and hundreds of thousands of people who are paying those premiums, or in the case of people who get their benefits through work, through group policies, where all 80 people at that company, all 4,000 people at that company, most of the people at a big company are signing up for that insurance, and either they or their company or both are paying the premium. So for each person, the insurance company is getting $16 a month, $60 a month. For good policies that are some of the ones that people have are individual policies, the insurance companies are getting $500 or $600 a month from people that have bought the really expensive, good high end policies. But for all
Right.
those people, they're paying those premiums, and the insurance company is gambling on what?
They're not needing it.
That none of them are going to get sick and become disabled, that none of them are going to die and have to be paid out the life insurance. Now they know a certain percentage are going to have a claim, and that's something that's called an actuarial calculation. So there's people in the insurance business that go to school for this stuff, that learn this stuff on the job, and they figure out actuarially, which is really the game of big numbers. Let's just say a life insurance company sells a policy to a million different people. What's the percentage chance that somebody is going to die out of a million people each year? Well, there's a certain percentage of that. Unfortunately,
Right.
some people are going to die. And if the policies only cover people till they're 65 or something like that, because it's at work, it can be a pretty tiny percentage of people that are under 65 that die at any given time. So the insurance company gets the money from all of those premiums that are being paid, and they figure out mathematically there's a certain number of claims we might have to pay out. So,
Right.
number one, the insurance company collects all that money, and what do they do with it until they have to pay it out? This is the first way insurance companies make money.
They hold it. They make interest on the
They
money.
hold it, and what do they do with it?
They loan it to themselves. I have no idea. I'm just
The
making up stuff.
So they actually have, most insurance companies have a department within an insurance company that's a whole separate group of men and women who sit around and figure out what's the best way to invest the money. Do we put it in the big mutual funds? Do we buy
Well,
individual
that's what making
stocks?
interest. That's what I was
Yeah,
saying.
so
But
it's
you're talking
it's
about
not just
making,
putting it in the bank and
yeah,
making small interest, it's actually investing the money.
yeah,
Now, actuarially, they have people who, back in the old days, the stereotype would be the guy down in the basement with a green eye shade and garters on his arms, kind of doing the accounting and figuring out, okay, mathematically, out of this million people, we're going to have to set aside this much money this year, and this much money next year, and this much money the year after that to pay claims. And though that money they have to set aside for people who either are going to have a claim or have already filed a claim, they know they're going to have to pay it. That money's called reserves.
Mhm.
So the insurance company makes money by, first of all, putting taking whatever money comes in and putting it in investments. But if they have to set the money aside for reserves because they know they're going to have to pay a certain amount of claims each year, that money has to be put aside in a special kind of an account where they don't put it in a risky place. And because it's risky, I mean, because it's not risky, it generates a lot less in terms of percentage of income, in terms of the how much you get paid as a percentage. So if you invest in aggressive investments with the money you're allowed to aggressively invest, it might pay 10% a year. But if you have to put it somewhere safe because it's the reserves for the insurance company, it might only pay 2 or 3% per year. So
Well,
the
this
insurance
real quick, this is just like if you've got a personal budget. I wouldn't know about what I'm about to say, but if I've got $10,000 extra a month, if I want to put 8,000 in something that's going to have a higher risk, then I know I can make more. But I got to put 2,000 aside because that's where the bills get paid, and that's where I'm not losing that money because I've got to have that as a fail safe.
Yeah.
Yeah.
So the insurance
Okay.
company knows it has to put a certain amount of money aside. And in fact, most states have laws where they call it statutory reserve requirements, that the insurance company has to put aside a certain amount of money that they have available to pay claims based on the estimated math of how many people are going to have a claim. And the money that's put aside gets a lot less interest because it has to be put in safer investments than the money that is put in their ordinary investments. So that's
Right.
the first way they make money, is the two different types of investments. And what
Okay.
does an insurance company want to do with that money? They want to put it in the more aggressive investments as much as possible. So they will have people who will do things to try to figure out what's the least we have to have in reserves at any given time. There's
Right.
no incentive to have extra reserves. There's an incentive to have less in reserves. The second way an insurance company can make money is if they figure out, okay, for every $1 million that we take in premiums, how much are we going to have to pay out if somebody becomes disabled or dies? And the percentage that they have to pay out might be, let's say, 90% of that. So they have to pay for every $1 million they take in, they have to pay out $900,000 for people who actually have claims. That means that they have a 90% claims ratio. That means 10% of every dollar they bring in, they're going to get to keep in the
Right.
long run. Now, out of that $10, they got to pay their overhead and their expenses. Now, some types of insurance, they end up effectively having a 100% claims ratio. They're going to pay everything out eventually, but it's going to take so long for it to be paid out. They have a lot of money they can invest in the meantime. Other insurance companies are looking and saying, okay, we're going to be able to invest the money at any given time and have this big giant float and all this money, but also we're going to make more money if we can have our claims ratio be as low as possible. If we can keep it to less than 90%, if we can get it to 88%, we can get to 87%.
And that doesn't sound like a lot until you're talking about hundreds of millions of dollars.
And that's what big insurance companies do. So if you're talking about an insurance company that in any given year has to pay out $500 million in claims, and you move it by 1%, 1% is $5 million out of
Yeah.
500 million. So that's $5 million extra in profits just by moving it 1%. And 500 million is actually kind of small potatoes for some of the insurance companies in terms of what they're doing for claims. They're talking about big, each department might have that kind of level of claims. The other way you can think of it that insurance companies make money, though, and goes into where we end up. We'll go back to your question about the different ways insurance companies are going to deny these claims. Is if you have the money set aside in reserves for somebody who's on claim or has filed a claim. So let's say you become disabled, just hypothetically. I know you're not, Clint, but let's just say you couldn't work anymore because you got run over by a bus and you had a broken back and couldn't use
Right.
your arms or legs anymore, and you file a claim. And they sit down and calculate, well, if we're going to have to pay Clint under his policy $3,000 a month, and Clint's 40 years old, and it's going to be so 25, 27 years of future benefits, we figure out, and I'll just do a rough estimate and say that, they have to set aside $400,000 to pay that claim based on the math. And we'll talk more about that math to make sure people understand that. But if they've got to set aside $400,000 to pay that claim over time, and then Instead of paying that claim, they deny it entirely. That's $400,000 they can move out of their reserve account and put it in their
Yeah.
regular investment account and call it a profit, and they've made $400,000.
Can that oh, go ahead.
One more thing,
Yeah,
and
yeah.
even if they eventually, like, if you hire a good lawyer and you sue them, and then you reach a reasonable agreement with them that they'll pay you what sounds like good money, $250,000 to settle that claim, or $175,000, depending on how good your facts are and how good the claim is. Well, that's great. You get that money for sure. You've settled. You can get on with your life. But what has the insurance company done? It's
They
able to.
made $150,000 profit.
They made $150,000 profit that was in the reserve account. They were able to take it out of the reserves and now put it in the general account, that where they can draw a lot more interest,
And when it comes to
discounted as
their
profit.
yeah, when they get to end of the year, statement, then look how much more they had planned to keep that in reserve, and because it was moved to profit, they just increased the way they look on paper, which is really one of the end
Yeah.
goals.
So here's the even more dirty secret. Insurance companies have figured all this stuff out a long time ago. This is not news to them.
Right.
So they are constantly looking for ways to adjust those percentages, even by a tiny amount, to pay fewer claims in the first place, to have a lower claims ratio. And when they do have to settle claims for as low as possible, and to not pay them out, to not pay the full amount of anybody's claim if they can avoid doing it. And they actually, in some for some insurance companies, they actually have ways that they sit down with the claims department to measure what are the number of claims that we accept at any given time. Now they say, well, this is our average. We don't aren't supposed to get over that. But if you put pressure on claims people to tell them you're never supposed to go over a certain number, when in fact there are valid claims over that number, you're putting a lot of pressure to deny valid claims.
They're looking for things they can deny or at least kick the can down the
And it
road.
right, and it builds a culture with these in these insurance companies of the people who are just supposed to be fair in evaluating claims and give a full and fair review of the claim, and instead they have a mindset of, "No, if I can find a way to deny this claim, I'm gonna deny this
Well,
claim."
that's the incentive structure. We talk about that on other podcasts all the time, what we expect from things around us. But I mean, if the incentive structure is solely profit, not making profit in a fair way, if we remove them, and I'm not saying they're not moral companies, so just ease up. I'm just saying if we remove the morality of it, and like you said, you bought a promise, we're trying to find a way to get around that promise, then all of a sudden, like you said, it's a lot of pressure, and it ends up being a struggle. I personally am one of those people, and you know my situation, that there's somebody probably looking at my stuff every week going, how do we get there? He's got another, maybe 10, 15 years, 20 years. If he extends his life and surprises everybody, we're going to pay this guy way too much money. I am in their target zone, my friend. And so it's a scary place to be once you realize they don't really have your best interest at heart when it comes down to profit.
Yeah. Now let's go back. You asked a great question a little while ago, starting to say, well, what are the different ways that they can take advantage of people? And it starts with the premise number one is most of the insurance out there that covers people for long-term disability, people get it through work. So it falls under a federal law called ERISA, the Employee Retirement and Income Security Act of 1974, a law originally designed to protect employee benefits. But what's happened over time as the law has developed is that it's created several rules that are in favor of the insurance companies. And one big one, mathematically, is that if an insurance company denies your claim, let's say you become disabled again, and go back to that story that they're supposed to pay you $3,000 a month, and you have a great claim, you're really disabled, you've been hit by a bus, have a broken back, and you're in a wheelchair, and your arms are damaged with nerve damage, you can't type on a computer anymore,
Right.
and the insurance company denies you anyway, they get to save that $3,000 a month, and they don't pay it out. If you find the right attorney, and we'll talk about the different steps where they can take advantage, but ultimately, if you find the right attorney and the attorney helps you sue, and we go to court and we get a judge to say this decision by the insurance company was wrong, or under the ERISA rules is so wrong that it was unreasonable, and therefore, Mr. Powell, Clint, you're entitled to these benefits. What does the insurance company have to pay you for going for 3 years without your benefits while you hired a lawyer?
I don't have a clue.
Just the benefits due under the policy,
Oh, wow.
plus maybe attorney's fees.
Okay, that's what I was
But
gonna ask.
there's no extra punishment under ERISA. You can't sue for punitive damages. You can't sue for the the way that they cost you the loss of that money over time. That you can't sue for anything called an extra contractual damage. That's what we call it in law. That basically would punish the insurance company for denying that claim.
Can I ask just a really a curveball?
Yeah.
So Clint's been denied his claim. I'm a year into my denial. Something else happens with me that's somewhere in that's caused by that same thing. It's a side effect. I've had a heart attack, or now I've got another issue. Is that do is that a separate claim, or does that go in? Can they deny that too, or does every claim get its own case number? I kind of know how this goes, but
So for a
I,
basic long-term disability case, which is most of our clients, let's say they get a group policy at work that covers their covers them if they can't work anymore. The basic definition of disability says if you can't work anymore because of your disability, whether it's an illness, whether you got cancer, or an injury, you got hit by a bus, or you broke
right,
your leg skiing, or whatever happened. If you can't work anymore at your job at all, you will get paid 60% of what you were making before you became disabled. Now, some policies pay 70%, 65%. I've seen 50%.
right.
60% is the most common. We'll pay you 60% of what you were making before you became disabled. We're also going to subtract from that any money you get from Social Security disability. So if you're so disabled, you're totally disabled and can prove to Social Security disabled, we'll subtract that from what we owe you. That's right there in the policy. If you have kids
Wow.
under 18 and they get part of your Social Security money, which is extra Social Security money that's paid to somebody who's disabled that has dependents, we will subtract that from this policy. But whatever money is left over that we're supposed to pay you, then okay, we're gonna that's how we calculate how much we're gonna pay per month, period. If you can't work anymore. So the fact that you got hurt so bad you couldn't work anymore and then down the road it gets worse, doesn't matter. You already have the
Okay.
full claim. The full claim is can you work anymore?
Gotcha. Okay.
Now, some policies, not most, but some have a partial disability or residual disability provision where if you become a little sick or a little injured and you have a loss of earnings, typically that costs you to have 20% loss of income, then you can file a claim and get a portion of your benefits. And then if you get worse, that percentage can go up until it gets to 80% loss of earnings. And at that point, you get your full benefits. But if you're already totally disabled, no, it doesn't matter if you keep getting worse.
Yeah, I got you.
Then you're just the question is you only get X number of dollars per month.
Okay, I understand. Sorry,
Right. No,
I just you know.
no, that's a great question. So making sure people understand how that works. Now, if somebody buys a private disability policy, a lot of those, instead of saying you get 60%, they will say you're going to get $5,000 a month, or $3,000 a month, or $10,000 a month, or $15,000 a month, $20,000 a month. I've seen we've had cases where we've had clients who were very successful doctors, very successful professionals that had paid for the policies that would protect that income that they had earned by going through all those years of medical school, all those years of college, all those years of being fantastic doctors, and then something happens to them, and they're supposed to get $20,000 a month or more, and the insurance company, oh hell, you know we're not going to pay that claim, or we're not going to pay all that claim, or we're going to say it's
Mm,
only partial disability and only pay part of it. So those are all the kind of fights we're getting into. If somebody has a policy through work, though, the important thing to remember for this part of the conversation, we'll talk in a minute about what happens if they don't have it through work. But if they have it through work, it falls under ERISA. The insurance company, the worst the insurance company has to do is pay the money they would have paid you in the first place. Plus, if the court allows it, maybe a little extra money for attorney's fees based on the number of hours your attorney, the number of hours our firm spends working on the case in court. It's usually not enough to cover a full percentage of the benefits that we usually charge as a contingency fee, but it'll make it a lot better. But at the end of the day, the insurance company losing in court only happens sometimes, and they only have to pay attorney's fees sometimes, and it's a very small percentage. What happens to all the rest of the cases the insurance company denies? They either win and didn't have to pay a penny, or they settle for something less than the full present value, the full reserve amount, and they've saved that money. And it doesn't happen often enough that they have to pay attorney's fees, that in the law of big numbers, the insurance company really has any punishment for denying these claims as often as they want to.
That's what I was gonna ask legally, and maybe I'm getting again, I tend to get the cart before the horse on some of this stuff. So if we need to stop and go backwards before we go forwards, but is are we at a place now where I can ask, is the law set up to help me or help them? Or is the answer yes?
Yes, the ERISA law was originally designed to help the employee. That was the concept behind it. But Congress was very, oh, how would I say, loose in terms of what the actual rules are. And Congress specifically said courts are supposed to go out and, and fill in the gaps in ERISA and develop a common law of ERISA. Develop so the courts are supposed to figure out how to interpret it. And what happened over the this was in the 1970s they passed the law. What happened in the 80s and 90s, the insurance companies did a very good job of having their attorneys argue that the way ERISA should be interpreted is ways that are favorable to the insurance company. So some examples, we've covered this in other podcasts and
Yeah,
other videos.
people may not see those, so
Yep. Well, so examples are that when you go to court in an ERISA case, the court will only look at the information that you submitted to the insurance company. So if you don't hire an attorney to help you with your appeal, you don't usually have the best evidence that you could get. It's not just your medical records. I've had clients come to me and say, "Well, I've already filed the appeal. I gave them all my medical records." And I'm like, "Oh crap. You've
well,
just
and there's a
really screwed up.
deadline to that too.
There's a deadline to
Yeah.
that." So the point is the court will only look at what you submit. You need to hire an attorney during the appeal process so we can help with things like sworn statements from your doctors, hiring a vocational expert, maybe getting a functional capacity exam. There's a whole laundry list of things we help people make their case better. We turn all that into the insurance company, and sometimes the insurance company changes their mind and pays the benefits. Great. We've won that case. But a big chunk of the time, the insurance company denies the claim anyway, and so we end up having to take the case to court. So one of the things under ERISA is the federal judge who looks at that case is only allowed to look at the evidence that was submitted to the insurance company. We're not allowed to have your doctor come in and testify. You're not allowed to testify. We're not allowed to get any new evidence that we didn't already get in. And if you try to do it on your own, that's like somebody trying to go to trial on their own without an attorney and standing there with a professional attorney on the other side hammering them. The insurance company is not looking out for you during that appeal process. So that's one big way that ERISA hurts people. Another way that ERISA hurts people is because what I said earlier, when you sue and win, you can't get any extra money to punish the insurance company to teach them a lesson not to deny claims. Another way that ERISA is a pain in the butt is because the Supreme Court said way back in the late 18, 19, late 18, late 1980s,
Wow.
in the late 1980s, in a case called Firestone Tire versus Brudge, that if the right paperwork is put in the policy, then the insurance company gets the benefit of the doubt in court. And so it's not just can you prove the insurance company was wrong, but you have to prove they were so wrong they were unreasonable. Now, there's lots of arguments that we make as good attorneys to show why somebody's decision was unreasonable. There's also arguments that we know how to make to show that they shouldn't be allowed to have that deference, that either state law doesn't allow it or they violated the claims regulations in a certain way. But it's so complicated, and the judges are so used to these cases being decided under what's called this arbitrary and capricious standard of review that it's an uphill battle in court. You have to have a really good case with great evidence and an attorney who presents it the right way to really have a chance of winning. So the insurance companies win these cases more often than they should. If you were just to say, well, didn't this person qualify as disabled under the policy? I mean, judges will literally say in some of these cases, if I was deciding this case for myself, I would say this person's disabled, but that's not the test. The test is whether the insurance company was reasonable, and in this case, they were reasonable. So I can't say they were unreasonable to the point of being so unreasonable I'm overturn their decision. That
Mhm.
actually is what can happen in these ERISA cases. So all of these things about how the law is beneficial to the insurance company leads them, and this is what I want to make sure we get a chance to tell people. What you asked a little while ago is, what are the different ways that an insurance company looks at this and says we can save money?
Yeah.
So the first thing the insurance company is doing is saying, okay, if we are not fair, if we bend over in a certain way to deny a bunch of claims, what's the worst that can happen to us? And the answer is a few cases are going to go to court and we might have to pay the other side attorney's fees. But we're not going to get punished by any court for doing this because there's no extra contractual punishment,
Right.
extra damages. There's no punitive damages in ERISA cases. So
Yeah,
if
we're
you're
not really out anything more than we expected to pay originally.
yeah, and let me give it a let me. There's a couple different ways I've tried to explain this. Give an analogy. If you knew friends in high school that went and stole a car and they take it and they drive it down the road and they have stolen that car illegally and the police pull them over and all they would have the worst punishment is they have to pay the fair value of renting that car for the half an hour that they stole it and that's the only punishment. How many people would steal the car?
Yeah, yeah,
If there's no punishment for doing the wrong thing, then why not keep doing the wrong thing? If it's purely just a matter of business or economics.
yeah,
If you're just a company with no morals, why do anything different if it's just a matter of economics? So let's start at the beginning. If
yeah.
the insurance companies have thought about this and said, okay, the worst that's going to happen is in a few cases we might have to pay attorney's fees, but for the most part, we're not even going to have to pay the benefits if we deny somebody and we will win a lot of these cases. Why not do it? So the first thing that happens is they will deny claims and the average person out there might not realize that they have an appeal process they need to go through and they just don't go through the appeals process. They don't hire an attorney. They don't uh, have somebody look at it for them. They just miss the deadlines. They never appeal. They don't think about it. I don't know why
Well, I
some
want to I
some
want to jump in and real
yeah,
quick because I'm the layperson. I've been in this
yep.
situation. I've got the denial letters, and my claims were so massive that for 6 months we're talking, $250,000 of claims that they're like, oh, by the way, we're retroly saying, hey, we're not covering this anymore. You owe us. Good luck with that, by the way. And I've got those claims, and one of the things that I think happens, and I say this on other podcasts when you and I have been guests, Eric, is I don't speak insurance. And so when I start trying to read the denial, I understand the part where it says we're not going to pay you. That part's pretty clear to Clint. It's the oh, and by the way, if you disagree with it, that's in the four font on the back, written like the old English, New King James. I mean, the
And
old,
my favorite part is usually in a color shade of gray that's slightly darker
oh,
than the paper it's
and
printed
if you're
on.
having glasses like me, and so they're using these words, there's 5 dates that are like written on this date, and it was sent this date, and this is the deadline. If you miss that, it's this date. I don't know really what date it is. I don't understand half of the words you're using. I can barely read it. All I know is you're denying me. And the things, here's what I think. The things they want you to read, like send your, your done, your if you want to fight this to this address, that part I can read fine. So I'll do what I can, but I don't really comprehend what's going on.
And one of the most important things is that they do not tell you that if you file an appeal on your own, that that's your only chance to submit any evidence and anything that an attorney might be able to do to make it a better case, you're missing your chance. They
I
don't
want you to
tell you
say that
that.
again.
Even
Say it again. Say that for
yeah,
the people in the back.
yeah, even if you read all that language, you get a magnifying glass out and you can read all that 4-point font or read the whole letter carefully. It does not tell you that one of the rules in these ERISA cases is that the court will only look at what you submit to the insurance company. So if you try to appeal on your own by writing a letter saying, no, I'm really disabled, and you get your doctor to say, no, she's really disabled, then
That's it.
that's not a good appeal. And that's all that's going to be in the record when your case goes to court. There's not just medical records, but your doctor explaining just specifically what you can and can't do. A functional capacity examination, maybe a vocational expert showing why your disability would actually preclude you from doing the kind of work. All the evidence that my firm would put into that case doesn't happen. So the first thing that happens, let's go back and now that we kind of made this clear, is that a lot of people just don't understand their right to appeal and either don't talk to an attorney right away. They miss the 180-day deadline that's in most LTD policies. There's a shorter deadline for life insurance cases that's right there in the letter. But if you miss the deadline, courts have said your case is over. You're done. If you do realize that you need to do something within the deadline and you do it on your own, typically people have not done the best job making that appeal a good appeal so that there's great evidence in the case. So that makes it harder to win later on. And then there are the people who are wise enough to go, oh my gosh, this is a lot of money. I want my case protected. I'm going to go hire an attorney. There are a lot of attorneys out there that do other stuff, personal injury work, whatever it is. They don't regularly handle ERISA long-term disability cases. And so they may not know all the landmines and pitfalls and dangers of handling an ERISA case the way that our firm does, and a few other firms around the country that do these cases regularly. We've learned those rules. So if somebody hires an attorney, even if they go hire an attorney and the attorney doesn't know what he or she is doing, then the insurance company's got a much better chance of winning that case. And let me give you a specific example of how I know about that. There was a law review article from, I don't know, 8 or 9 years ago, where some law students and a law professor did a full survey of all the ERISA cases out there, and they determined that most of the ERISA cases for ERISA benefits were filed as long-term disability cases, and the insurance company won over 60% of the time, close to
Mm.
65% of the time. However, of all those, the 100% of those cases that were filed, somewhere around a third of them, 1 in 3, were filed originally in state court or in federal court, but claiming that they were state law breaches of contract cases. In other words, 1 in 3 cases were filed by an attorney who didn't realize that he or she was handling an ERISA case.
Mm.
A full third of the
Wow.
time, the attorney didn't know that they were handling an ERISA case. And so a bunch of those cases that ended up being lost, that where the federal court found against the person, the law review article almost literally says the first line of most of those opinions from those judges saying this person loses starts out, this case was originally filed as a breach of contract claim under state law, and the defendants claimed that it falls under ERISA, and this court agrees this is an ERISA case. And if you've gotten that far and not realized you had an ERISA case, even a good attorney doesn't necessarily understand that they were supposed to put all that stuff into the claim file and make it part of the record so that it's actually something the court can look at. And that's one more big reason why the insurance companies are going to end up winning these cases.
Oh, man, it's terrible to lose on procedural stuff that could be avoided simply by hiring the right person. I've got to go get a root canal next week. My dentist told me, he said, "Hey, that's not what I'm good at. I'm good at teeth and I'm good at mouth stuff. And there's some things I'm better at than others, but your root canals, I don't, I'm not, it's above my pay grade." So
That
they're
sounds like a
sending,
fun time, by the way,
oh,
Glenn.
but
I'm really happy that you're
I'm
going to take
really
a day off to do
looking
it.
forward.
Yeah. So
Looking
that's some
forward to
real
it.
me time there.
It is. Well, but my point on that is he's sending me to somebody who that's all they really do. So there are no surprises. They can look at it and give me a good assessment. I'm not going to waste time, money, or have excess pain going through something twice or losing it. That's simple, simplifying it down is kind of what you're talking about. There's a lot of people that may be good at air quote claims and insurance, but when you get to something this specific with such big things at stake, you want somebody that goes, "Oh, no, 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 no. We're not doing it that way. We're going to do it this way. And here's why. Give me the file and let's get going."
Yeah. So let me recap this just real quick. So when the
Yeah.
insurance company is thinking about them. Are we going to pay a claim or not? And they're looking at the law of big numbers, and they have a system in place of not paying as many claims as they should. They don't care because a certain percentage of people are just not going to appeal. A certain percentage of people are going to appeal on their own. A certain percentage of people are going to try to appeal and miss the deadline. And all of those people are going to make it awfully easy for the insurance company to deny the claim.
Right.
The certain percentage of people who think about all that and go, "Oh, I might better go get an attorney," if they don't hire an attorney who regularly handles these ERISA cases, they might not be doing themselves much good. And then, even if they do the right thing, they figure out that they have this complicated case that falls under ERISA. They hire an attorney like us that handles ERISA cases. We can't guarantee we're going to win every case. We win a lot. And if you go to our website, you can see a list of a lot of the cases that we've won historically, but each one has its own facts. We know how to put on the best case, and we settle a lot of cases because the insurance companies know that we've got a good chance of winning, and that they know that they need to pay a reasonable amount of money to settle these cases. But we're not going to win 100%. So the insurance company's already saved all the money on the people who don't file an appeal, all the people who didn't do it on time, all of the people who hired the wrong kind of an attorney, and then they're still going to save some money winning some cases even against the good attorneys.
Yeah.
So at the end of the day, if there's barely any punishment of just occasionally in a small percentage of cases having to pay attorney's fees, these insurance companies are going to deny valid claims.
Yeah, yeah,
Now,
and their
is that
incentive.
good? Is that good for me and my employees that we have a job? Yes. Is that good for our clients? Hell no. That's why we're here, to
Yeah,
help people that have been that have a valid claim, that have a real condition that keeps them from working. They're going through this really bad time in their life where they can no longer do their old job, and they have this medical condition they're worried about, and then they have to deal with this insurance company that's going to absolutely try to deny that claim if they can. They're not going to be fair about it, as fair as they should.
one
That's
thing.
why that's why they need the help of someone like us.
It is, and one thing we don't bring up a lot, and we're gonna wrap this up in the next 5 minutes or so, but one thing we don't bring up is something you kind of just alluded to. I've got this massive denial. I'm confused. I don't know if I've got the right attorney. If I need an attorney, I'm scared. Oh, and by the way, most of the time when I'm having to make a claim of this size, I'm not having the best quality of life either. It's probably straining my relationships. I don't get to do a job anymore. There's probably emotional baggage that's coming with that. I don't know my situation. I may have transportation issues, financial issues. It's not like I'm sitting and this is the only thing that it's impacting is my insurance claim. No, it's impacting my life. And it can get real murky sometimes.
Yeah, we deal with a lot with our clients. We try our best to help them with this and help them understand this. But if you think about somebody who's worked very hard in their life, now they have a medical condition. They're worried, am I going to get better? Am I not going to get better? What's my quality of life going to be? There's that problem. There's the financial problem of, okay, I don't have an income anymore. How long is it going to take before I get my LTD benefits either paid or settled? How long is it going to take me to get Social Security? And then there's the emotional problem of dealing with the fact that I may never be an accountant again. I may never be a lawyer again. I may never be a dentist again. I may never be a doctor again because I can't do that anymore. So what does that do to me psychologically if that was a big important part of my
Yeah.
life? And
Yeah.
you have all that all laid over the fact that this insurance company is playing games with these complicated rules because they know they can do it because that's what they do for a living, and they will take advantage of these people in this very difficult time in their life. That's what we're here for, to help people at least figure out a little. They have enough to worry about. Let us worry about their ERISA case or their disability insurance case. And I know we got to go in a minute. We want to keep this short. I just want to mention real quick, not everybody's case falls under ERISA.
Hmm.
So the question that some people may have, well, don't people sometimes get punitive damages or extra contractual damages? And the answer is yes, of course they do, but it depends on the state law where your policy was issued. So first of all, we're talking about people who bought an individual policy directly from an insurance company instead of getting a group policy through work, or sometimes even accidentally getting their individual policy through work. It still falls under ERISA. But if we can get it out from under ERISA, then we look at the state law that applies. Where did you buy the policy is what most states will say, or what state had the most contacts with this policy. Sometimes what states will say. But if somebody bought their policy in a state like, for example, Pennsylvania or California or New Mexico or Nevada, though, and there's other states, those states have very good law that will allow you to sue for more than the benefits, to sue for punitive damages. And it's great that that law is out there. The problem is that a lot of courts are reluctant to give those punitive damages, and juries are reluctant to give those punitive damages. So even in those cases, the courts know it's going to be very rare for there to be a case that goes all the way to trial and for the jury to agree not only is the person disabled, but the insurance company did something really, really wrong. So we fight for that, and we fight hard to have those rules apply. um, and so that's the leverage we have in settlement. It's also some of the stuff we're arguing for in court and current cases we have going right now, for example. But we just never know when we're if we're going to win punitive damages, and the insurance company knows it's not that often in the big picture, big numbers game. On top of that, there are some states where if you get your policy that the law's not so good. So we've worked with attorneys, for example, from New York, and in New York, there theoretically is bad faith law, but in practicality, the standard for getting it is so hard that it's just impossible. I'm licensed in Georgia, so I can actually tell you about Georgia law. In Georgia law, there's a tiny penalty for bad faith. It's horrible. I'm licensed in Tennessee. In Tennessee, it's a tiny penalty for bad faith, but there is a law that allows for punitive damages for something called an egregious breach of contract. and we're having some fights right now in some court cases about how that works. So can you actually get punitive damages in Tennessee under that law or not? And that's a fight we have right now going on with a an insurance company in Tennessee and one of our dentist clients. So the the bottom line is the insurance company is going to try to deny a lot of these claims, unfortunately. And if you don't get an attorney involved who knows what they're doing, you don't hire somebody like us, they're going to take advantage of you. They're going to walk all over you. And even when we help, it's not every day we make the insurance company pay extra, but we can help a lot of our clients at least get something that's fair, or at least something that makes up for the way the insurance company has treated them, or at least gets them some of the benefits that they're due, which is way better than they're starting out with nothing when the
Well,
insurance company denies that claim and they don't have any help.
I want to as we get close wrapping it up, I want to just say I think it's a good idea if you have a policy first to get your policy out, read through it. I'm a big believer on looking stuff up. While you've got when you're not in an emotional crisis, look stuff up, know what your policy is, know what some rules are, maybe do some research on it because a lot of times you don't know. But here's where I'll say the last thing I'll say before I give you the floor to wrap it up. I think it's a good place to start as a lay person like myself who's got a policy to just know one thing. The insurance industry is set up, it's incentivized not to pay you. So if I know that going into it and I get a claim, I get a denial, if I know that's the incentive from the get go, I'm going to be very proactive. I'm going to be very diligent. I'm going to be reading stuff. I'm going to come talk to an attorney like you. I'm not going to waste time because I know their incentive structure. So this is not fair play. They've got my best interest at heart when they start denying me. That's my 2 cents.
Yep. And so let me just say this. Anybody out there who has sat through this video so far, Glenn, anybody who's been listening to us so far, I think they've taken the right first steps. They've started thinking very hard about what their rights are, what their claims are, and they've been curious enough to start asking the questions, what can I learn about this? So follow up, call us. We'll be glad to talk to you about your policy, about your claim, tell you whether think what we think about it, and offer to help you. That if we can, if it's the type of case that we can work with, we work with a lot of people. We can't help everybody who calls us. Unfortunately, not everybody has the right kind of case. There's lots of factors, but we're pretty darn good about talking to people and figuring that out and figuring out if we can help. So if you have a long-term disability policy, a disability insurance policy, a private policy of disability insurance, or life insurance through work, life insurance on your own, and a family member has passed away and that they don't want to pay and you're the beneficiary, those are all the kind of, and we've occasionally done some big healthcare claims too. Those are in our wheelhouse. Anything like that, give us a call. We'd be glad to talk to you about it. And I'll just say this: I appreciate anybody who sits down and listens to these videos and wants to learn, because that tells me something special about a person, that they are willing to try to figure this stuff out and
Yeah.
want to listen.
And get answers to questions.
Yep.
BuchananDisability.com is a great place to start, which if you're watching this, you're probably already there. If not, go check it out. BuchananDisability.com. Eric, I think it was a good one, man. I appreciate the opportunity again.
Yeah. Thanks for your time today, Clint. Good
All right.
job.
Bye,
All
everybody.
right.
See
Bye.
y'all.